Hello, and welcome to the Aperam Q4 2019 earnings conference call. My name is Mahan, and I'll be your coordinator for today's event. Please note this conference is being recorded, and for the duration of the call, your lines will be on listen only. However, you will have the opportunity to ask questions later on the call. This can be done by pressing star 1 on your telephone keypad to register your question at any time. If at any point you require assistance, please press star 0 and you'll be connected to an operator. I will now hand over to your host, Maulo, Chief Executive Officer, and Sandeep Jalan, Chief Financial Officer, to begin today's conference. Thank you.
Hello, good morning everybody. Thank you for attending Aperam's earnings conference call. Next to me is Sandeep Jalan, Aperam CFO, and together we will present the result of the fourth quarter 2019. Please take note of our disclaimer regarding forward-looking statements. We start from health and safety on page 3. In Q4, our LTI frequency rate remained elevated at 1.9. This is due to the high CapEx spend for new projects and maintenance. We employed a high share of contractors and external parties during Q4 that are more accident-prone than our regular employees. This is another reminder that we constantly need to work hard and diligently toward our goal of becoming a zero-accident company. Now let's move to the key development in the fourth quarter on slide 4. The market environment remained challenging during Q4. The seasonal improvement was soft in Europe, while Brazil was seasonally weak. In total, 2019 was the most challenging year since the inception of Aperam. In this context, we achieved a solid adjusted EBITDA in line with guidance and a very strong free cash flow, both for the year and during Q4. Cost savings are one of the drivers for this. We realized gains of 90 million euro through the leadership journey in 2019, and we remain well on track to achieve the targeted 200 million by the end of this year. Imports continue to flow into Europe during Q4, so we welcome the decision of the European Commission for registration of hot-rolled imports from China, Taiwan and Indonesia from January 24th. We remain mildly optimistic for additional trade measures from the anti-dumping and CVD investigation, but we will discuss this later. Aperam published ambitious environmental targets for 2030. We also plan to become a carbon neutral company by 2050. Today we have an industry-leading CO2 footprint, which we want to defend by reducing CO2 emission by another 15% till 2030. We also target a 40% reduction in water intake and plan to cut dust emission by 70% versus 2015 baseline. We are today an integral part of the European recycling landscape with our Recyco unit and more than 85% scrap input in our European austenitic production. We seek to improve our position further by increasing the recycling rate of our own waste to over 97% till 2030. Independent agency rate us highly for our ESG achievements, but we constantly strive to minimize our environment footprint and will continue to be a fair employer with the highest corporate governance standards. Finally, I would like to share good news from Brazil, with a positive outcome of a long-standing dispute regarding PIS/COFINS with tax authorities. We have booked 16.8 million euro credits in Q4 and expect further earnings before taxes of up to 200 million to come during 2020. Let me now elaborate the environment on the next slide. The market environment in 2019 was the most challenging since the inception of Aperam. We experienced a substantial volume contraction together with a massive price deterioration. We experienced both on such a scale only in a recessionary year so far. On the volume side, we see two major reasons at work. First, weak real demand across all the sectors due to the slowdown growth in both Europe and Brazil. Second, distributors destocking amplify the market contraction. This caused 9.5% decline in our shipments as we followed a strict margin over volume strategy to continue to be the most profitable and cash generative stainless steel producer. Imports also had some effect on volumes, but the major impact was on pricing. Asian competitors dumped the material in Europe. According to CRU, the average base price in 2019 was 35% lower than in 2017. This was the last undistorted year before the global trade war started impacting Europe in 2018. Putting this into perspective, with 9% lower volumes and a 35% price decline, not many companies would remain profitable. However, despite a recessionary-like environment, we generated a solid adjusted EBITDA of 340 million and a cash flow that fully covered an 11% shareholder return via dividend and share buybacks. This is not small achievement and was made possible by completely transforming the company through the leadership journey over the past years, a program that will continue beyond phase 3. I hand over now to Sandeep.
Thank you, Tim. Good morning and a very warm welcome from my side as well. Moving on to slide number 6. Quarter 4 is usually a seasonally stronger quarter than quarter 3, but this year volumes declined by 4% compared to quarter 3. A soft seasonality in Europe, weak demand in Brazil, skyrocketing imports and nickel price-induced destocking were the main reasons for this slower volumes in quarter 4. Despite this, we were able to achieve a slightly higher adjusted EBITDA compared to quarter 3. Margins expanded on the back of the leadership journey gains and inventory valuation gains. EBITDA during quarter 4 additionally has benefited from an exceptional 17 million euro gain from the positive PIS/COFINS decision in Brazil. PIS/COFINS is a federal tax towards social security contributions that is levied on sales. The issue was that the taxable basis for these PIS/COFINS federal taxes also included the state tax, ICMS. So this was like a tax on tax, which many companies in Brazil, including Aperam, were disputing for the last 2 decades. Now, pursuant to a favorable decision by the Supreme Court and also by relevant courts during the last quarter in our own cases, 17 million credit has been booked during quarter 4 2019 in our Brazilian results. Aperam will potentially be able to also recoup overpaid amounts and account for additional pre-tax income of up to 200 million euros after approval of the court and confirmation by the tax department for recovery of these overpaid amounts. These 200 million euros pre-tax income is will be 50% in EBITDA and roughly 50% in the financial income as interest for these past years. And these are expected to be recognized in the profit and loss during the year 2020, while the cash collection, net of tax, would take several years. Tax expense includes 26 million euro non-cash impairment of deferred tax assets in several jurisdictions. Due to these items, earnings per share during this quarter has declined to 36 cents despite the higher level of EBITDA than in quarter 3. Cash flow is again the star performance this quarter. We could deliver the promised release of working capital, and further with our low cash cost below EBITDA, we were able to convert 160% of EBITDA into operating cash flows. Part of the working capital release is seasonal and will flow back in quarter one, but structurally we could still release some working capital during 2020. Capital expenditure at 52 million euro was seasonally elevated due to the ongoing Genk cold rolling mill project, and 2019 capex was fully in line with our guidance. Adding 30 million euro cash flow from the complete divestment of the Gerdau equity stake resulted in a final total of 140 million free cash flow during this quarter and a low net debt of just 75 million euros. We are happy with this solid set of results in an extremely challenging market environment. I hand now back to Tim for in-depth look at the market environment on slide 7.
Thank you, Sandeep. Let's look at imports first. To cut a long story short, these were in line with our projections and some fears. There was no change in the fourth quarter despite the revised set measure having included Indonesia. So annual country quotas allow the imports to capture a disproportionate share of 32% in Q4 and 30% for the full year. Quotas run until June, but China has already exhausted its hot rolled quota at the end of January, and Taiwan used 72% already. Imports accounted for 46% in European hot rolled market in Q4, and in December it was the highest ever number at 59%. This clearly shows that trade action is a pressing issue, and we are encouraged by the European Commission to start registration of hot rolled imports from China, Indonesia, Taiwan from January 24. The three countries under investigation accounted for 84% of all hot rolled imports into the European community in 2019. So the anti-dumping decision could make a difference. Also, the CVD case, countervailing duty, anti-subsidies, on China and Indonesia should be concluded by July this year. The cold rolled market share of imports at 26 in 19 and 28 in Q4 remains high versus the baseline of 22% that was the safeguard aim. Turkey, India, Taiwan, Malaysia and Vietnam also run visibly above their pro rata share of the quota. We urgently need to discuss with the European Commission to align quotas with the market development in Europe, as smooth flows by making country quotas quarterly. Nickel price remained volatile during Q4 and has a large degree reversed the Q3 unusual spike. Obviously, this promotes destocking as stainless steel price followed nickel lower. Stainless steel inventories are below last year's level in absolute tons, but slightly elevated for this time of the year. Also, the weak real demand yields high inventories days, which is the core driver for the actors, in particular distributors. This adds a soft seasonal recovery for Q1. The price delta versus Asia has declined to a relatively low level, which indicates high price pressure in Europe. Base price remains substantially below the historical normal level. Concerning demand, this has not changed during the quarter. In Europe, automotive, white goods and capital goods remain stable at a low level. We continue to see good demand in construction and general industry, but real demand has been clearly declining in 2019. In Brazil, automotive remains good, and capital goods growth is coming from pulp and paper and ethanol. White goods are held back by low consumer sentiment. Construction growth has been weak despite improving sentiment because infrastructure spending remained low. Oil and gas has not started to recover. Now I hand over to Sandeep for a review on the leadership journey.
Thank you, Tim. Let's now take a look at phase 3 of the leadership journey results on slide 8. We are happy with the continued good progress towards our targets. During the fourth quarter, we added annualized gains of 18 million euros, and this brings total gains for 2019 to 19 million, and the cumulative gains for phase 3 so far now 223 million euros. Quarter 4 gains were dominated by procurement of raw material and purchasing in general. The top line strategy also contributed to the good results. 77 million euros remain to be captured now during 2020, and we are well on track for realizing our goal of 200 million gains by year-end 2020. Please be assured that we are working additionally on new ideas, both for cost and growth, and that we will share with you in due course of time. Phase 3 of the leadership journey will definitely not be the end of Aperam's transformation, and we expect to continue strengthening Aperam's performance. Capital expenditure associated with the leadership journey was 5 million euros during this quarter and 19 million euro during the full year 2019. The cumulative capital expenditure was 83 million euros against a total plan of 100 million, implying a remaining 17 million euros spent mostly within this year. The realization thus remains well within the plan. We have updated slide 20 in our quarterly presentation to allow you to keep easy track of the improvements in Aperam's results over time thanks to the leadership journey actions despite a very difficult market environment. I now hand back to Tim for the outlook.
Thank you, Sandeep. We go to the next page for the Q1 outlook on slide 9. Despite the first quarter being seasonally stronger, we only expect a comparable adjusted EBITDA. Real demand has remained soft in Europe and Brazil. We also expect a negative inventory valuation during Q1. While the registration of imports is clearly positive news, any impact should be felt only in Q2. We expect net financial debt to increase seasonally due to higher working capital. After taking a close look at analyst estimates, we conclude that for a given level of earnings, our operating cash flow is systematically underestimated. Hence, we are providing some detailed guidance to assist you in your EBITDA and cash modeling. We plan with a capex budget between 110 and 120 million for 2020. Obviously, lower volumes require lower maintenance. The budget also includes the remaining 17 million for the leadership journey and capex to finish the Genk project. We expect a tax rate of 20-25 for 2020. Only about half our P&L interest payment and effective tax rate are cash items reflected in the cash flow statements due to non-cash financial charges and deferred tax asset. Please bear in mind that on top of above, the PIS/COFINS refund will add to EBITDA and cash flow later in 2020. We maintain a stable dividend in line with our progressive dividend policy and our earnings that implies a sector-leading yield of 6.5%. We have also simplified our dividend policy to avoid confusion. We deleted the intention of a 50 to 100% payout ratio. Aperam has a progressive dividend strategy with a base dividend of euro 1.75. We will review this only in the unlikely event that net debt to EBITDA is above the 1x. Due to our strong balance sheet and in line with our financial policy to earn back excess cash to investors, we also announced a 100 million share buyback for up to 3.8 million shares. You can take this as a sign of confidence in Aperam's ability to generate a very attractive free cash flow, even in the most difficult market conditions. Finally, you have seen that Sandeep has decided to leave for personal reasons. After a long career in steel and mining industry, he has decided to give his career an entire new orientation, leave his comfort zone, and start an adventure in a new industry. I'm really grateful for Sandeep's tremendous contribution during these 7 years with Aperam. He will still be with us till May, which gives us enough time to find a suitable successor. I regret that he is leaving, and I wish him all the best for his new career. Next page, as usual, we conclude our presentation with the corporate tax asset schedule. We are looking forward to meet you at one of these events and provide you plenty of opportunity to address your question in person. We are ready now to take your questions.
As a reminder, if you'd like to ask a question or make a contribution on today's call, please press star 1 on your telephone keypad. To withdraw your question, please press star 2. You will be advised when to ask your question. And the first question comes from the line of Alain Gabriel from Morgan Stanley. Please go ahead.
Yes, good morning, gents. 2 questions from my side. Firstly, on the maintenance capex level that you've guided for 2020, I'm just trying to get a sense of how sustainable that level is, given that it's materially below your depreciation level. Should we expect an underspending in 2020 and then a ramp up again in 2021? That's one. And then 2 is on the outlook for Q1. You mentioned demand remains soft in Europe and in Brazil. Can you give a bit more granularity on the order books, inventory levels, any evidence that we are seeing of a restock in any of the regions? Thank you.
Hi, Alain. Regarding your first question regarding the maintenance capex, we have always given a guidance that our maintenance capex is anywhere around 70 to 100 million range, and this includes several improvements in the leadership journey. So during this year, you can see that we are giving a guidance for next year, 85 million euro, and we are very happy to cover all our maintenance requirements while continuing to progress with new investments like Ghent line, for which we are allocating 35 million euro during next year.
Okay, so concerning Q1, we see two elements. The first element is Brazil. In Brazil, there is a seasonal effect that is well known, so it's the period of their holidays around January, and then the second part is Carnival that takes a lot of importance for them. In Europe, normally Q1 is a very strong quarter, is not as strong as Q2, but is a strong quarter. But this strong quarter is somewhere in continuity what has been the situation of all the years, with some sector and some countries which are weaker than the usual. And so we consider that this has not really showed sign of a dramatic change from last year. So we are mostly in continuity with last year, different from the historical level that Europe has reached. You see that for the first time Europe in real consumption has been below the previous year.
Thank you.
The next question in the queue comes from the line of Tom Zhang from Credit Suisse. Please go ahead.
Thanks. Morning, gentlemen. Thanks for taking my question. 2 quick ones, please. Firstly, could you help quantify maybe the raw material related inventory impact in this quarter, and to what extent we expect this to reverse in Q1 given nickel and ferrochrome price movements? And then following on the outlook again, could you just give any color on your realized base pricing or product mix, if there's any impact from those on your Q1 outlook? Just looking at CRU, for example, it looks like there was a tick up in January base pricing, but that doesn't really connect with some of our on-the-ground sources. So any color you have on the direction of pricing would help. Thank you very much.
Hi. So regarding your first question regarding the raw material inventory valuation effects, all of you are well aware about the volatile movements that we have seen over the past 2 quarters for nickel, and nickel started massive rise during July and August, which had very important effects with the time lag that we have explained over the previous call. It had a certain positive valuation effect during Q4, and we have seen then subsequent declines in nickel starting towards latter part of Q4, extending into Q1, and this is leading to certain negative impacts which we cannot fully quantify at the moment. Clearly, Q4 to Q1, the net impact is negative, and this is part of our guidance that we are guiding for Q1 a comparable EBITDA compared to Q4. However, when you exclude these effects, clearly we can see improvements in the underlying EBITDA.
So comparing base price, it is quite difficult to give a guidance which is different from what I said before. You see, we have a page in which we show what is the situation of the market. We are exiting a quarter, the Q4, with a very high level of imports, at a record high level, with a very low, let's say, the apparent demand, and with prices which have been under pressure. So we see, let's say, more longer term possibility of improvement, and in particular with the effect of the filling of the quota, which for certain products is happening now at the end of January, and for the possible announcement of anti-dumping measure. But this is still to come. As you know, there is also always an inertia in this kind of movement. So price is not yet moving. We have to see also what will be the consequence on the imports in the first quarter. So we will be, let's say, more aware of what will be the evolution of base price at the end of this quarter. For the moment, we are not anticipating anything about that.
Okay, thanks very much. And just a quick follow-up on the mix. Does that play any role in your Q1 outlook, or do you kind of expect a flattish product mix versus Q4?
When you refer to mix, you refer to what exactly? Mix of products on stainless steel?
Mix of products, yep.
Yeah. No, but not significantly. So we don't change the mix significantly unless some industry goes up or down. So we don't see today any kind of segment which is particularly booming or dropping. So and typically the mix is linked to the segment to which you are selling. Of course, we have an improvement, a continuous improvement in our product mix, in the commoditization of our products. So our top lines have increased, and this explains in a big part the resilience of the results of the company, because on commodity, pure commodity has been the biggest drop in terms of volumes and in terms of price.
Okay, very clear. Thank you very much.
The next question comes from the line of Seth Rosenfeld from Exane. Please go ahead.
Morning. Thank you for taking my questions today. 2 different points. First, starting with the Brazil.
Sorry, we can't hear you. Can you be a bit louder, please?
Sorry. Can you hear me better now, please?
Yes, much better. Thanks.
Great. Starting out with the Brazilian tax gain, can you please give us a bit more color on what tax rate you expect to be applied to this gain as we go forward? Ultimately, what should the cash benefit be in benefiting your balance sheet over the medium term? You commented on it taking several years to achieve the full 200 million net cash benefit. Any sense of timing on that? Secondly, with regards to stainless scrap prices, can you just give us a bit of a sense in terms of how you view the stainless scrap market developing into 2020 in a lower and more stable nickel price environment than we saw in 2019? Obviously, this past summer, you saw those discounts widen to near all-time highs. Do you think that those discounts in percentage terms are sustainable, or ultimately do you expect the scrap price to be much more stable than what we've witnessed in nickel of late? Thank you.
Hi, Seth. So regarding your first question regarding the Cis-Coffin gains, so we expect, in addition to the 17 million euro that we have recorded during quarter 4, we expect further 200 million euro of pre-tax income. And on this, yes, you are right that there will be some taxes that will be imposed. As you know that in Brazil, the statutory income tax rate is 34%. But at the same time, you know that we do have certain deferred tax assets, and that includes Brazil as well. So our net cash tax should be far lower, more in the range of around 24% or so. And this cash recovery we would expect over several years, while the P&L recognition we would expect after all these procedures completed to be recorded during during 2020 in the P&L, and the cash flow during next few years.
Okay, on scrap, so I can't give a guidance on what will be the scrap discount or price during the year, of course, but the mechanism is the following. Scrap is one raw material and follows the trend of all the competing raw materials. So the competing raw materials are nickel pig iron, ferronickel, and all the nickel vectors that we really use in our let's say stainless steel production, while the pure nickel, which is the LME grade, is not used directly for stainless steel producer. So the adaptation of scrap discounts or price, let's say, because discount is only a way to price at the end, will continue to follow, of this we are convinced, the general trend of the raw material. When you see very high discount publicly named, this is because there is a decorrelation between what is the LME and the real price of the raw material. LME has had a spike in Q3, which were not supported by a real demand for nickel or a real, let's say, consumption of nickel pig iron, ferronickel at much higher prices. And the same has been for scrap. So I am expecting that the scrap will continue to be a usable raw material. Usable means that has to compete with all the rest of raw material that are being used to produce stainless steel.
Great, thank you very much.
The next question in the queue comes from the line of Rochus Brauneiser from Kepler Cheuvreux. Please go ahead.
Yes, thanks for taking the question. One general question on the European market. As you mentioned in your presentation, you have been suffering a significant decrease in the volumes, particularly during the second half of the year, and you're now pointing to a rather muted recovery. What is your current thinking about the 2020 shipments overall in Europe? Do you think a further decrease in the shipments will be most likely again, as some of the market might be lost to imports, or are you still hoping that the impact from the potential anti-dumping duties would be strong enough that this could be, to a certain extent, corrected? That's the first question. And the second question is in regard to your capex guidance. To what extent would come any incremental capex on top in pursuance of the climate targets you are setting for the current decade? And thirdly, can you please get a bit more specific on the positive windfall effects you have benefited from in Q4?
Okay, so It is a bit early to give a guidance on what will be the volumes on 2020. But what are the, let's say, factual reason or the factual facts on 2020 compared to 2019? So in 2019, the safeguard was not including Indonesia. This is a fact. And this will have an effect. And so we see that already in Q1, some quarter are filling up with the inclusion of the Indonesia. The second effect will be that we have the registration of the import, and the registration of the import is, let's say, something positive. We can't say today that the anti-dumping is not done, but is something positive, and we will continue to work with the European Commission to be sure that they will level a fair market. The third point that is totally unknown today is the economy. Is unknown in the sense that we have had a 19 in which many countries and sectors have suffered a lot. Now, is this the end of this decline in terms of real consumption or not? This is still very early to be said, but for the moment there is a stabilization and there is a seasonal effect that will happen in Q1 and Q2. So all this will be the real fact, and then we will see during the year. Philippe, you want to take on the windfall?
So on the capex guidance, we already had this question earlier. Overall, we are comfortable with the guidance on the capex that we are giving, and this includes all the actions on the environmental actions, which is part of our 2030 targets, and we have concrete plans internally within the company to realize those targets that we have announced. Now, as I said earlier, we are working on additional ideas, and clearly we can see the potential to go beyond leadership journey 3, and both in terms of the cost and other potentials, and we'll be working on those ideas, and later on we'll be coming back what are the kind of capex allocation and the saving potentials that we can offer in the environment. Then regarding your last question, Rochus, regarding windfall during quarter 4. On windfall, we are not giving any concrete numbers as such. As you know, our stand, we have always considered it as part of our results, part of our adjusted EBITDA. This is the basic model of our business to work with the variability of nickel and inventories, and sometimes it's positive, sometimes negative. And as I said earlier, it was clearly a positive effect in quarter 4, an important one, and in quarter 1 it would be a negative effect, at least based on the nickel position that we see as of today, and this position is still developing, and based on that we will see those impacts in our books.
All right, thank you very much.
The next question in the queue comes from the line of Bastian Synagowitz from Deutsche Bank. Please go ahead. Bastian, you're now unmuted.
Can you hear me now?
Yes, now it's okay.
Perfect. Good morning, gentlemen. I've got 2 questions left, and my first one is actually just on the seasonality and volumes in the first quarter, and maybe what you can already see for the second. I think you talk about weaker than usual seasonal improvement in Europe in the first quarter. Could you please let us know whether you've seen just any notable change in the patterns of your customer behavior since the beginning of the import registrations, which is obviously fairly recent, and maybe also give us some color in whether you expect that to impact the market in the second quarter already. And then my second question is just to follow follow-up on the Brazilian social insurance overpayments. Could you please be a bit more specific on the period in which we should expect you to collect the majority of the cash? Are we looking here at a 5-year time frame, or maybe rather a 20-year time frame? I guess it may depend on the earnings performance, which we obviously don't know, but any color on that would be great. Thank you.
Okay, so for concerning Q2, you have the typical effect that are coming. So Q2 is the strongest quarter for Europe in term of consumption, in number of days of opening of the industries. But it also is the full opening of Brazil. So it is seasonally also a quarter which is strong for Brazil. Now, as always, Q2 tend to be the stronger in terms of volumes for Aperam due to the addition of these two facts. We don't see for the moment, and we are not anticipating major disruption in the behavior of customers. But okay, this is very early in this kind of industry to pretend to know what the customer will do in 4 to 6 months.
So, hi, Bastian. Regarding your second question concerning the cash flows, so as you have seen that we have delivered a very strong cash flows during the last year, and going into quarter one, we do have seasonal effects. As you have seen during all the previous years, we do have a stronger pickup in volumes and some seasonal effects in the working capital that is leading to build of inventories, etc. Overall, for the whole year, of course, as you have seen, as in our past years, we have been generating very, very strong cash flows thanks to the robust profitability as well as below EBITDA items being very, very low in terms of the cash flow impact. As you can see from our cash interest, which is about 10 million as per our guidance, and cash taxes being around half of our ETR guidance, expected effective tax rate being around 20 to 25%, and only half of that converting into cash taxes. So overall, cash generation ability of Aperam will continue to remain high, apart from the seasonality, but they reverse. In particular about PIS-COFINS. PIS-COFINS should further strengthen this cash generating ability of Aperam. As I mentioned earlier, all these additional amounts, 17 million euro that we accounted for in Q4, as well as 200 million euro that will be accounted for during this year. These amounts, net of the taxes impact, would be recovered over next several years, and this would, of course, lead to additional cash flows for Aperam.
Thanks, Sandeep. Just to follow up on that, I mean, as I said, it's going to support your cash flow, but I mean, can you give us any guidance on whether we are looking at a maybe 5-year time horizon for you to collect those Brazilian cash benefits, or is this more like a very wide 20-year time frame which we have to think?
Yes, Bastian, so we are looking more at a 5-year horizon. Again, there are a lot of, let's say, complexities involved in this documentation and the process.
Sure.
Where we are not at the end, there are certain approvals needed as well. So we are following that very closely, and during next quarters, we should come out with a bit more precise guidance and clarity concerning that. But yes, I mean, and overall, we see like a 5-year horizon at the moment.
Okay, perfect. Thanks, Sandeep.
The next question in the queue comes from the line of Alan Spence from Jefferies. Please go ahead.
Hi, thank you. Just 2 quick ones remaining from my side. And just firstly, on what we were talking about on Bastian's question there around tax, can you just confirm whether this will definitely come into your proceeds, or is there any kind of decision you're still waiting for to get confirmation on it?
Yes. So regarding the 17 million that we have accounted for, these are the credits that already belong to us. So they are already in our returns, and we will start recouping this very shortly. Regarding the other 200 million euro, as we mentioned earlier, there is still a part of the documentation and process left to be followed, and clearly we are trying to accelerate it to complete it as soon as possible. And at the moment, as the decision stands today, both the Supreme Court and the local courts, the position stands at the amounts that we are indicating, which is around 200 million euros, half in EBITDA and half in financial income. And of course, as we go along the process, we'll be able to give you more clarity.
Okay, thank you. And I'm going to try one last time around negative inventory valuation for Q1. I know you mentioned it's provision, and part of that is going to depend on where nickel prices trend in the remaining part of the quarter. If nickel prices end the quarter where they were today, can you give us a very rough number of what you think that negative inventory valuation might be? Is it, for the sake of this, say, less than 5 million or above 5 million?
Look, we have never given a guidance because this is a very difficult number to give, and even if I give, you should not trust me at all, because this is not a number that is any of us can control, and it's part of our results, and it will be an important number based on the nickel as it stands today. You remember the nickel went up last year from $10,000 to $19,000, leading into these positive effects, mostly during quarter 4. And yes, it is unwinding a little bit now, a lot actually, going back to levels below 13. So yes, it is having an important effect on the quarter 1 results as we stand today. But I'm sorry, I won't be able to give a number there.
All right, I thought I'd give it a shot anyways. All right, thank you very much, guys.
The next and last question in the queue comes from the line of Christian Georges from Societe Generale. Please go ahead.
Thank you very much, and good morning. 2 questions. Your alloys and the specialties division, so you did about 50 million euros EBITDA this year, so it looks like we are pretty much normalized. Is this an area where you see some potential for further improvement as far as profitability is concerned, or is this more likely to become a running rate? That's my first question. And my second question is with regards to Chinese production. We've had the ban on ore exports in January. Now, obviously, we've got this virus issue in China. I mean, do you see potentially some impact on Chinese stainless steel production in the first half of the year between those 2 factors? Thank you.
So, thanks a lot for the question of alloys on specialty, because this is really an area in which we are fully confident that we are not at the end of our growth, and the results are proving that this is a business which is sustainable, which has behind a demand which is not volatile, on the contrary, continuously grow, and we see also that we have trends in which we are positioned like, for example, in the very high end of the some aeronautics application or automotive application, or in LNG, so the liquid gas, in which the potential of our division is tremendous. So we are working on this, and we are very confident on the continuation of the growth of this sector. Now, concerning the consequence of nickel ore ban on China and what will happen, we see that there is a lot of factors that play in the game. So there is abundant nickel coming also from ferronickel. There are more and more investment of nickel pig iron in Indonesia, which will provide a nickel pig iron, which is a raw material for China. So I'm not an expert of this nickel, but it doesn't seem a sector in which there will be a shortage in the short term.
Well, thank you. But just one last question. The spike of the nickel price in the last quarter, that suggests that the inventories of laterite and of nickel in China at stainless steel mills have got quite a high value. Would you agree with that?
No, we don't know. Absolutely not, because there are two effects. The first effect is what is in LME. LME is linked to financial transition and position that some operators take. And what is the reality of the nickel content in the vectors that we use in the stainless steel, which are scrap, nickel pig iron, nickel ore, ferronickel, which has been decorrelated from this spike, which has been temporary and has been resolved after a few months.
Okay, very clear. Thank you very much.
This concludes the question and answer session. For further questions, please contact the Investor Relations Department. I would now like to turn the call back to Mr. Maulo for any additional or closing remarks. Please go ahead.
Okay, thank you very much for having listened to us and asked this very relevant question. So I would like to conclude this 2019 years because I think it's a pillar of what we are as Aperam. We have been facing really a market which I personally have never seen so weak and so bad in terms of imports, in terms of price. Probably never in my life, 30 years life in stainless steel. We have seen imports which sometimes were unbelievable in figures, like 59% imports in December for hot roll is something which in an industry should never exist. We have seen a strong difficulties in convincing the European Commission in going for a fast implementation of efficient measure. So we have seen a lot. And despite this, we have had an EBITDA which is, let's say, not what we can expect from this company, but a sustainable EBITDA with a generation of free cash flow which is extremely high, and with the capacity of this company to focus at the fundamentals when this kind of situation comes. And the fundamentals for me are the focus on the cost competitiveness, on customers, on the fact that on the cash allocation and the discipline even in the capex spending in the way we do everything, we are we are maintaining the resilience and the long-term sustainability of the company. You have seen also that we are very actively working on environment and on ESG in general, with good results that the progress and the results are witnessed by the recognition by the competent auditors. So I'm very happy of this set of results at the end of the year, which gives a lot of hope for what is coming now from now on. What will come from now on is embedded in our strategy leadership journey, in the new investment of Genk, which will ramp up during the last part of the year, in all the investment we have done to improve the competitiveness of the company in the last years, and the fact that we still have potential to further decrease our working capital and continue to be a very cash generative company. So thank you very much, and see you in the next roadshow or meeting that we have already planned. Bye-bye.
Thank you. Bye-bye.
Thank you for joining today's call. You may now replace your handsets.